All investing is subject to market risk, including the loss of principal. Past performance is not a guarantee of future results, and there is no guarantee any investment strategy will achieve its objectives. This information is provided for illustrative purposes only and is not a prediction, projection, or guarantee of future performance. This podcast is provided for general and educational purposes only and is not intended to constitute legal, tax, securities, or investment advice or recommended course of action in any given situation. All opinions and views constitute our judgments as of the date of production and are subject to change at any time without notice. Welcome back to the Dakota Studios. I have your host, Chris LeRoy, and I have my colleague here, Alex deMarco. And today we have an exciting guest, Ian Glaser from BridgeInvest. Thank you for joining us today, Ian.
Thanks, Chris and Alex. It's a pleasure to be here.
Well, it was very exciting. We're going to be covering a wide range of topics. We're going to be talking about real estate, particularly attractive time in the markets today. There's a lot going on. But just to start, Ian Glaser, partner of BridgeInvest and investment committee member. Ian oversees capital markets, business development, and investor relations at BridgeInvest. Ian has closed over $2.5 billion of commercial real estate loans and has structured 5 commingled funds in various special purpose vehicles at BridgeInvest. Prior to joining BridgeInvest, Ian was a member of the alternative investments group at Credit Suisse, where he helped oversee private equity and hedge fund strategies. Ian received a Bachelor's of Arts degree from Columbia University, graduating with honors. Just to start, we're going to cover the firm that you work for today. You've been with the firm for a very long time.
Yeah.
So you've seen the firm grow and expand and develop. And just to start off, I'd love to just kind of focus on kind of what was the original vision for the firm and how has that evolved as the market's changed?
You know, BridgeInvest is an investment manager based in Miami, Florida, and we've been exclusively focused on sourcing and structuring, investing in diversified portfolios of senior secured commercial real estate across the asset spectrum, across different stages of the lending life cycle, and really across the country. And the vision of the firm really started on the heels of the global financial crisis. So my partner, Alex Horn, who's the managing partner of the firm, also my college roommate 20 years ago. So we've been close for many years, was from Miami originally, and his family office saw a unique opportunity to invest in commercial real estate at that time. And he flew me down to Miami in 2011, and we looked at the Brickell skyline at night, and we were looking at a bunch of half-lit buildings, rising vacancies, and he said, this is the opportunity right in front of us. We have capital, we can act where others can't. So at that time, we saw a significant mismatch between developers and real estate investors who had kind of half-complete projects, prized assets, waterfront, and they didn't have the capital available. Most of that was driven by the regulatory environment at the time. So Dodd-Frank, Basel III, imposed very strict capital restrictions on banks, particularly assets that were going through some sort of transition. So whether it be construction, value add, if they weren't stabilized, it was really difficult to access debt financing at that time. So we started the business doing kind of small loans on our own balance sheet, and then sort of invited friends and family along the way. And the business organically grew over the last 15 years. Today we're very proud of the fact that we've invested over $2.5 billion across 160 loans. We've already successfully launched 5 funds, now have over 40 employees, and we've stayed true to that investment strategy since the first day. Continue to be focused on really senior secured credit and these risk asymmetries that we identify, particularly in the middle market. So these are loans between 10 and 100 million. Too large for kind of the local banks, the local investors, but too small and often overlooked by the Wall Street firms and large private equity funds. So that's kind of the sweet spot. And we like kind of exploring that inefficiency. It's a pretty fragmented market. So if you can develop a sourcing machine that kind of goes direct to sponsor, that's also something that we've really focused on. And finally, just to wrap up, we decided early on to kind of create a vertically integrated model. So that means that we touch every sort of cycle of the lending, lifespan, whether it be, origination, underwriting, servicing, asset management, all the way to disposition. We like to control that from end to end. And we think that really adds value along the chain.
And you mentioned that sourcing component too, and we'll come back to that. I think it's a really important point. And when we talk a little bit more about the firm's investment process. But you mentioned you and your partners worked together for over 10 plus years, college roommates, which is a unique story too. So how does that longevity shape the culture and alignment of the firm?
Yeah, it's a great question. And I'm smiling because ultimately you're kind of blessed to work with people that you trust, that you have a really great personal relationship with. And early on, I think we decided to sort of cement core values for the business. And it was sort of at odds with the investment banking culture that we grew up in the early 2000s, right, which is pretty cutthroat and frankly not very collaborative. And so we decided to kind of recreate what the culture of the firm would be, which would be based on kind of an entrepreneurial spirit, open dialogue, kind of removing any kind of silos, but also based on integrity, transparency. We have no ego as a core value. So we really focus on kind of humility and hearing any kind of voice in the room, whether it be junior voices. We often encourage our analysts to speak first in the meeting. And then finally, kind of holding ourselves up to the highest of standards. We kind of codify that as being no less than your best, right? And so I think that shared core of set values is something that we brought with us. And then we kind of brought, people that we thought would complement our skill sets and that were friends. So like Daniel Stahl, who's our CEO, was a high school friend of Alex's. He was a Six Sigma, went through kind of a lot of bankruptcy and restructurings with Wells Fargo. John Gimman, who's my other partner, went to Wharton here in Philadelphia and focused on real estate investment for distressed Class B and Class C offices in apartments 20 years ago. So we wanted to kind of create this, this team that had, different skill sets. And to this day, we kind of grew up together. So we started the firm in our mid to late 20s. We've gotten married, we've had kids together, and I think having that connective tissue has really helped us endure challenging times, whether it be COVID. When we sat together in a room and we had debates of, are we coming back next week? And I was like, I think we're coming back a year from now. We had just rebuilt our office space in Miami. Whether it be, we had Hurricane Irma once where Alex and I were both married to physicians, and they were sort of in the hurricane shift, and we had to close a deal on lockdown in the hospital in 2017. Whether it be, the rate hike cycle that we went through. So having those deep relationships really helps you kind of endure those challenges and build and iterate from there. Yeah, I think another aspect of our culture is also reflected in how we have relationships with our LPs. So transparency, open access, our LPs have a direct line of communication with the partners in the business. And I think that's created alignment and long-term trust, especially during, challenging market cycles. And with respect to alignment, I think we always made a conscious decision to invest alongside our investors. We always invest our proprietary capital in each and every transaction, every fund, on the same liquidity terms as our investors. So that's the type of conviction that we have in the strategy. And we also share in all fees with our investors. So the philosophy is we wouldn't be able to invest without their capital, without their trust. So why should we earn, an origination fee up front? We have to share all of that with our investors. So that would include prepayment penalties, default interest, any kind of modification fees that we can earn as additional alpha. It goes into the revenue pool of the fund, and then it's shared with our investors. So I think that culture is not only permeated in our team, in the partnership, but also in our long-standing relationship with our LPs.
Yeah, and absolutely. No doubt. You've definitely seen multiple cycles too over the firm's history and 5 different funds that you've raised so far. So what would you say BridgeInvest's unique differentiator compared to other private real estate credit managers are?
Yeah, sure. So I think we're kind of differentiated across a few different aspects. I think the first would be we're hyper specialized. So we defined very early on that we would kind of double and triple down on being specialists in senior secured real estate. So we don't really focus on, mezz or pref equity or even equity. Even when rates were low, we saw a lot of our friends doing very well, across the aisle, if you will, like on the equity side. And we decided that there was this systemic kind of funding gap that we wanted to continue to refine and hone. So being hyper specialized, I think, is a key differentiator. The second would be, vertical integration. I kind of spoke about that earlier, which is that we want to have sort of a hands-on approach to every stage of the lending life cycle. And that even includes special servicing. So if a loan is kind of deviating from its path, if the asset is behind on its leasing schedule or construction timeline, we have a team of attorneys that were actually litigators in a past life that can go through workouts, that can shift a loan from performing to watch list, and kind of having that hands-on monitoring, I think adds value across, sort of the lending life cycle. Also, we talked about our sourcing capabilities. We're kind of proud to say that 40% of our sourcing last year was direct to sponsor. So these were not intermediated deals. That lends itself to kind of every stage of the asset life cycle. So we can sort of partner with a developer when they're shovels in the ground, with an acquisition of the dirt. We can kind of structure that pre-development loan. We can then have a ROFR, right of first refusal, in place to do the ground up construction. We can also do value add or adaptive reuse all the way to the point of stabilization. So like a lease up play where you're ultimately going to be taken out by agency or a bank loan. So the fact that we can kind of focus across that lending life cycle is a key differentiator, right? Most of our peers will focus on either a specific asset type or the later stages of what we call traditional bridge to stabilization. So I think those are the key facets. And then having this sort of deep conviction in being specialists allows us to be somewhat contrarian. So I think that when we started the business in 2011, lending in South Florida was not really something that most lenders were lining up to do at that time. It was a market in distress. There wasn't a lot of liquidity. We actually left Florida and sort of expanded into Texas in 2014 and 2016 when the price of oil went from $110 to $30 sort of over a year. And so we thought that was an interesting entry point to kind of be able to lend to some of those assets. During COVID, we expanded into the Northeast, New York, Philadelphia, New Jersey, when a lot of lenders were kind of heading south and coming to the Sun Belt. And now we're actually looking westward. We're looking to expand into California. We're seeing some really interesting basis in assets in San Francisco and LA, and actually just hired an originator to be focused on that area about 6 months ago.
That's excellent.
Yeah.
How would you describe the firm's core philosophy today? And I would be curious to hear how that's shifted as the private credit markets matured.
Our philosophy was pretty much embedded in starting our career in the throes of the global financial crisis. So, Alex Horn, who's managing partner, myself, John Gibbon, we all kind of went through that shock to the system, went through repeated layoffs in investment banking. So I think we had a profound appreciation of risk and how things can change very quickly. I think it's actually why we became lenders. And so it starts with capital preservation, right? Our philosophy, first and foremost, is about protecting, preserving capital. The way we kind of focus on that is by lending pretty conservatively. So on average, about 50 to 65% loan to value. So you have pretty significant equity cushions kind of behind you to support your basis, as well as kind of really using accretive leverage, but quite conservatively. So we've never really levered our book more than, one time a leverage. And traditionally, it's been about 30 to 50%. And also kind of having a barbelled approach where you can enhance yield by focusing on, development and value add deals that tend to command a higher spread. So today that's probably around 400 to 600 basis points over SOFR. And then complementing that with a portfolio of bridge loans that are, backed by near stabilized assets. So these are cash flowing multifamily projects, office projects that are tighter spread and could be levered because they have strong in-place debt yield. So having that kind of barbelled approach allows us to have what we think is a yield enhancement play as well.
So you talked a little bit about the capital preservation being a really important piece of the philosophy. We talked about it before we started shooting, how competitive the private credit landscape has gone. How do you balance capital preservation as well as getting sort of competitive returns in the market and being competitive with other peers?
Sure. Yeah, I think capital preservation and kind of yield enhancement are sort of two sides of the same coin. We don't see them as being competitive or at odds with each other. I think there's this old adage that you can't really have a return on capital if you don't have a return of capital. So we've been very fortunate to be able to kind of consistently distribute quarterly distributions since we started of at least 7% a year, and consistently kind of recycling the portfolio with an average tenor of 2 to 3 years. So I think being able to focus on consistency rather than trying to hit, high double-digit returns has never really been our philosophy. It's about consistent yield enhancement. So that's really how we kind of approach that. And I think, again, having an asset management team that sits side by side with our origination team allows us to have this kind of feedback loop where you're, sharing knowledge and you're able to kind of iterate your underwriting, and that kind of helps us actually enhance yield along the way as well.
Yeah, I'd like to dig in more to the vertical integration piece as well. You talked about that being sort of core tenet of the firm. How does that vertical integration muscle set help you create more value?
Yeah, appreciate the question. I think when we looked at, the broader kind of private lending space, we found that most of our peers would outsource certain capabilities. So particularly servicing. Servicing is essentially your communication with a sponsor. It's, issuing invoices, controlling things like escrow accounts and things like that. But also asset management and loan management. So a lot of that is outsourced all the way to the point of special servicing, right? Which is when you're going to go through workouts, and there's actual special servicers out there. So what we found is in the early stages of BridgeInvest, we would actually outsource these functions. And we found that we were always hearing about things secondhand. So like, oh, your loan is actually 10 days past due. It's time for you to communicate with your sponsor. And we found that there was this gap in terms of that information gathering and sharing, that we decided, why don't we build a team in-house that is 5 days a week, and that's really kind of specialized for their core function. And then we can, the sum is kind of greater than the parts. So I think that, we've had a lot of success with loans that went through some sort of NPL or workout. And we went through two real periods of challenge. One was, COVID, where the top line, in other words, your rents might have gone through challenges and your vacancy dropped. So we had to go through certain workouts and selling loans. And then the other one was during the rate hike cycle of the last 2 years, where cap rates expanded and obviously valuations kind of reset. And that was a really good sort of test for us in both cases, where we were able to sell loans in the secondary market, go through workouts, for forbearance agreements. We've even been through a few bankruptcies, and happy to say that we've had essentially a zero loss ratio over the last 15 years. And so I think that it's hard to quantify risk, but I think that the risk management is a core part of sort of our yield enhancement strategy.
And shifting a little bit towards the investment process for BridgeInvest, how does the team conduct diligence, and what specific criteria do you and your team look for?
Sure. So, diligence is something that we sort of refined over 15 years. So we now have a proprietary database of close to 10,000 loans that we priced, and we can actually put that in a database to allow us to kind of offer feedback in real time for our sponsors when we're originating loans. So we're able to, for example, issue a term sheet in 24 to 48 hours. And I think having that certainty of execution allows you to actually have some pricing power. So we may not be, the cheapest lender in town, but the fact that we have relationships with other sponsors that have been able to do construction loans, for example, and have discretionary capital behind us, I think is a real differentiator. But specifically, Alex, for your question about diligence, we have today a checklist that has over 200 items. It starts with the sponsor. So we focus on, who their capital partners are, how they're capitalized, what's been their experience. We actually interview their prior partners, their prior lenders. We go through their financials. We understand their operating agreements. We then dig really deep in the asset. So, our credit analysts are essentially focused on getting to an evaluation that is somewhat independent of the borrower's pro forma. So there's usually a little bit of a gap between how we arrive at value and how the borrower arrives at value. And we're typically triangulating, comps, whether it be leasing comparables or sales comparables, a reversion analysis, so like a DCF model where you're taking the future stabilized value back to present, and then corroborating that with a third-party appraisal. And we do things a little bit differently because we're very lucky to have a seasoned appraisal as part of our staff, Josh Rosen, who has over 45 years of valuation work. And he kind of does the triage. So he does the selection criteria and interviews and reviews the appraisal ultimately to arrive at values. So we kind of, compile all of that data, and then we complement that with third-party reports. So property condition reports, zoning letters, environmental reports, geothermal, traffic studies. We kind of put all of that into the mix. And then we issue a loan memo that's typically 30 to 40 pages to the investment committee, and we vote by unanimous consent, and then we fund the loan. So it goes through various stages. And again, this is a process that we've refined over really 15 years, and we have different lending criteria based on the type of loan. So if it's a land loan, how are we, enhancing the credit with interest reserves? If it's a construction loan, how are we monitoring the pace of that construction? Who's the GC? Are they bonded? Is there an insurance bond behind that? So I know I'm getting into the nitty gritty, but as you can see, it's really laser focused here.
And then from a sourcing perspective, is it mainly relationship driven, or maybe another means? Are a lot of your borrowers repeat borrowers?
Yeah, so today about 40% of our origination is based on sort of direct to sponsor, and 30% is repeat borrowers. And so we've been very lucky to kind of be a direct source of deal flow. We have a database of over 50,000 contacts that was built organically over the last 15 years. I would say that most of our sourcing today is inbound. So it's brokers and attorneys, real estate investors who are calling us because they know that our credit box is very tight, very specific. We don't really deviate from middle market, senior secured lending, transitional assets. And so that allows us to kind of have sourcing that's proprietary, that's efficient, that's flexible. And just to put some numbers around this, we sourced and reviewed over $52 billion worth of deal flow last year. So it's over 1,000 transactions. And we closed 18, which is roughly about 700 million. So we're still, converting about 1% to 2% of that. So you have to be incredibly selective in this process to be able to kind of, earn that yield enhancement that we were talking about earlier.
And then once you selectively underwrite and issue these loans, talk a little bit about how the asset management team steps in and oversees the life of that loan.
Sure. Today, we built an asset management team with 8 dedicated professionals. We manage a portfolio of roughly 40 to 50 credits at a given time.
Okay.
So if you kind of just divide that, you're talking about every asset management analyst is monitoring no more than 5 to 7 credits at a given time. So they have an intimate relationship with the sponsor. They're conducting typically semi-annual site visits. They're going through a questionnaire that was actually developed by our origination team. So we have a handoff, a transition meeting where the origination team will actually provide context behind, this is why we structured a covenant a certain way. These are the types of milestones that you got to be looking out for. If something deviates, these are the key criteria that you should be asking about. So having that in-house, I think, really helps. And then we also were able to hire experts in different sort of areas of expertise. So, for example, Trent Williams, who leads the team, came from a background of construction management. He worked for Deloitte in the State Department, kind of overseeing the construction of U.S. embassies abroad. And so he has, 20 years of experience sort of overseeing construction draws and working with their partners in terms of construction. We also have consultants and sort of data scientists who look at try to look at patterns in terms of how we're either deviating from or on par with whatever our pro forma was. So I think that's really at the essence of it, is you have a group of essentially investors and investment professionals, but they're all not focused on, managing 100 loans. They're managing 7 to 8 loans that they know intimately well. So the level of detail is akin to what you would see with like a real estate equity portfolio, but we sort of pursue it from the debt side.
Makes sense. Mm-hmm. And then love to shift to just the market environment today. So we were talking about looking at 1,000 loans this past year, and then being super selective, just getting to 1%, actually closing 18 deals. So we're seeing several $1 trillion of commercial real estate debt maturing over the next 5 years or so, I believe is what the stats are. Where are you seeing sort of the greatest opportunities as a firm today?
Sure. Yeah, absolutely. So first of all, I think what you mentioned in terms of the wall of maturities, we have roughly $1 trillion maturing in the next 12 months, roughly $3 trillion in the next 5 years. And just taking a step back, if you look at the commercial real estate debt market, it's roughly about $5.5 to $6 trillion. 40% of that is regional and large banks. 40% is life cos, agency, CMBS, and 20% is now alternative or private lenders. That's double what it was 10 years ago. So we've certainly grown in terms of the space, but where we're seeing opportunity right now is in sort of recapitalizing and restructuring debt that's coming due that was originated 3-5 years ago in a very low interest rate environment. So it's a really good asset, but maybe broken or bad balance sheet. So those are really tremendous opportunities. We also think that as rates are cut, in the next 6 to 12 months, that will lead to an inflow of new equity capital, especially for development. You're looking at construction starts at 40-year lows. So there's a tremendous demand for, new housing. It's probably the biggest structural issue we have in the United States, where we're short about 4 to 5 million housing units or multifamily units. And even though there's been sort of pockets of oversupply in markets like Austin and Nashville, that's actually being absorbed quite quickly in the next 12 months. So we think that going into 2026 and 27, you'll actually have that structural undersupply come back. And we really want to lean into development financing and value add financing, because I think that's where we'll command higher spreads.
And you mentioned this notion of basis too, in some certain markets like San Francisco and things like that. So just talk to us a little about those markets as well, where you're seeing opportunity there, if it's maybe in the actual CBD or if it's outside, or just what sort of trends you're seeing in those markets.
Yeah, absolutely. So, San Francisco, as well as even office in gateway cities like New York and Miami, you're able to lend. I'll give you an example. We lent on a Class A office in Miami about 3 months ago, fully leased. Our basis is about 70% of the acquisition price, which went out at a 30% discount to what it was at 2 years ago. So essentially your look-through basis is roughly about 20 to 30% of what this was trading at 3 years ago. And you're getting paid for that risk, right? You're earning SOFR plus 550 with credit enhancements on top of that. So that's the kind of basis play that really excites us. We're seeing similar, especially in San Francisco, central CBD areas. We haven't really transacted yet, but it's an area that we're actively monitoring. We like to kind of roll up our sleeves and do a lot of homework before we enter a new market. So typically we like to know who the local players are. We need to make sure we understand, the local tax laws, foreclosure laws. We have to partner with a local attorney. So it takes usually 6 to 9 months before we even transact in a new market. And so we're excited about that. Also, Sunbelt still has pockets of opportunity. You're still seeing kind of resilient job growth and migration patterns that have been sustained. But we're also seeing that in, the greater New York CBD as well. And lastly, I'll say industrial also excites us. We can lend at below replacement cost. Vacancies are kind of trending higher, but you can kind of look and choose and pick your spots with respect to IOS, which is industrial outdoor storage, for warehouse or fulfillment centers. We think there's going to be an added need for that, especially in the geopolitical environment that we're heading into.
So what it sounds like is this is a very unique part of the cycle, unlike prior cycles too, where you can really get paid to take the risk too, and then you also have this supply dynamic too that wasn't necessarily there before too, due to overbuilding and things like that.
Yeah, because private credit still is 15 to 20% of the overall market. So we think there is going to be this risk transfer for banks that are still sort of hindered by this regulatory framework that hasn't really changed. And the liquidity profile of banks changed significantly in 2023, right? During that banking crisis,
right,
with SVB, with First Republic, you saw this migration of deposits kind of leaving the regional bank into the bulge bracket banks and going into money market accounts. And these banks can really only lend a multiple of their deposits. So it's kind of interesting to see that the tail wagging the dog, where the bank will approach the private lender to kind of indirectly access the asset, but they want your deposits, right? The deposits are really going to drive that business forward. Whereas with private lenders, it's really about structuring the right solution, and it's asset-backed lending, right? So it's a different kind of framework in terms of that underwrite.
And the banks certainly, continue to face this liquidity crisis. Is that fair to say, from what you're seeing? So just with that in mind, do you expect private credit to continue to take share as it has? I think you mentioned 20% today.
Yeah.
Do you continue to forecast that to continue, private credit to still take share from banks over time?
We do. We think this is structural. It's not really cyclical. We also think it's a positive development for the lending ecosystem, because especially for certain risks like taking on construction or development risk, depository lenders aren't really well equipped to take on
Like this liability mismatch.
Exactly.
Right.
So whereas with private lenders that have discretionary capital, that are kind of looking at the risks eyes wide open and can kind of make that investment decision, I think that matches your assets and your liabilities. So we think this is generally a positive development. We also see kind of CMBS coming back from 2 years ago. So that's actually indicative of a healthier capital markets. It means that private credit can really focus on the transitional aspects of lending, whereas CMBS could be your takeout, or banks could actually serve as your takeout. So we're seeing banks coming back, especially for the near stabilized assets. But in terms of any kind of transitional risk that you take on, we think private credit will have a meaningful kind of role to play there.
And can you unpack that a little bit further, just transitional assets?
Sure. So that could be everything from what we call pre-development or land loan, right? Which typically we don't take any entitlement risk, but that would be an example is a prime waterfront piece of property that's zoned for 200 units multifamily in New York or South Florida. The borrower is going to come in with 50% of the capital through equity. We as a lender are going to fund the other 50%. And so that's the first sort of stage of transition. The second stage would be, okay, the plan's been approved by the city. Now we can go vertical. So we're going to be focusing on a construction loan until we get to a certificate of occupancy. The next stage would be, okay, now we have to lease up that asset until the point where you're 70, 80% leased. And then you could be looking at an agency takeout with Fannie or Freddie or CMBS. So those are the three main stages of transition. And we focus on all three. And we try to have sort of a barbelled approach in terms of our portfolio allocation.
And so when you're speaking with folks today too, are you able to provide solutions to all different stages?
Correct.
Versus just we're only doing one stage where, others might just only do one stage, and
that's
providing
right.
that flexibility.
Yeah,
It's key.
we cut our teeth. So going back to the launch in the early years of the firm, excuse me, we cut our teeth with sort of complex loans that were essentially land loans and pre-development loans. So they were, we could underwrite the asset. We could get to kind of what the stabilized value would look like on a discounted basis. There were very few lenders lending at that at the time. And then we kind of dialed up the complexity to get to something that's kind of near stabilized today. So in a way, our evolution was kind of inverted, right? So we focused on the very complex and hairy deals first, and now we're focusing on an underwrite that's a 1 or 2 year takeout where you're very close to stabilization. So I think that leaning into complexity has certainly helped us kind of unlock some of that risk premium.
How do you think about geographic diversification in the U.S.?
Sure. So, today we have our main offices in Miami, but we have originators based in Dallas, based in Pittsburgh, in New York, in Denver. And we have essentially 5 teams of 2, a director and an analyst level person that kind of divide and conquer, the 48 states. So it is kind of geographically structured. I think, we've already lent on over 20 states. We're very systematic about how we grow our lending presence in. As I mentioned, we usually like to spend 6 to 9 months even before we allocate to really get to know the local dynamics, because ultimately real estate is incredibly local. You could lend in Doraville or Asheville, but you're not going to lend in downtown Atlanta, right? So every kind of zip code submarket has its own idiosyncratic drivers that you have to kind of appreciate and understand. So it does take a little bit of time, but in terms of our overall allocation, we've always been very constructive in the Sun Belt. I think that's just given kind of where we are geographically, based in Florida. So we have a very active presence in the Carolinas, in Georgia, and Texas, all the way to kind of Arizona. Roughly 25% of our exposure is in the Northeast today. So New York, the tri-state area. We have about 10% exposure in the Midwest. And then we're kind of growing our exposure into California and the Pacific Northwest. So it all takes time. It's sort of organic. We typically like to avoid tertiary markets, secondary markets, particularly for office. We think that there is a structural obsolescence that's going on for most of the office supply in the country, with a few exceptions, right? We're being actually pretty constructive on office, as I mentioned, in Miami and New York. We also are being cautious when it comes to hospitality, particularly for business travel. And we're looking at, some of the indicative features of the economy where, you might have a slowdown in discretionary spending. You might have a relative softening in terms of the labor market. So how do we approach that, and how do we kind of defend in terms of our underwrite, in terms of our basis? We're not being paid to take equity risks.
Right.
We are always thinking about the worst case scenarios when we underwrite.
Yeah, and I think that's such a important point that you made there too, just about not just how hyper-specific the market is, but also the asset is for the market too. Like
Correct.
you mentioned office in Miami, and just the net migration, or
Correct.
just the employment growth there versus, a different asset in a different type of market that might not be a good fit to lend against.
Yeah, exactly. And there's been a huge trend on data centers. We find that it's actually quite difficult to compete in that space because the spreads are so thin. They tend to be actually self-financed by the hyperscalers. So we typically don't really lend on data centers, but we do lend on, for example, fulfillment centers, last mile logistics, especially if there is a credit tenant in that space, or it's a vacant center, but they have LOIs out, so we can kind of take on some of that vacancy risk, and you can earn outsized returns for that risk as well. So it's really about kind of understanding the local dynamics and then seeing how you can explore those. Most of that information comes from the brokers that we know, the real estate investors. Again, having that sourcing mechanism that is direct to sponsor is really a source of alpha for us.
Yeah, obviously, there's a lot of deals that you've passed on and are cautious on certain markets or certain deals. As you look ahead over the next 12 to 24 months, what are things that you think people should be paying attention to, but maybe aren't,
Sure.
In terms of the market?
Yeah. So, first, I think multifamily, class B and C, is getting somewhat stressed right now. You're seeing some stress in terms of delinquencies mounting. You're seeing savings rates kind of dwindling, and the job market could be softening a bit. So it's kind of a tale of two cities. For Class A multi, you have a tenant base that has incredible spending power and is incredibly resilient. Whereas Class B and C, we see in real time some structural challenges there. So I think we're going to be a little bit cautious. I talked about kind of just core office across the country. it's incredibly expensive to convert office into a new use, especially if it's 80s and 90s vintage in the middle of the country. I think that's actually a demo play where you're kind of thinking about it on the last dollar basis as land. So you have to significantly kind of de-risk and debase that asset. Hospitality is another one. It tends to be a higher cap rate asset. When you have a slowdown, and discretionary spending could come down, that's usually the first asset that you kind of see that correction. So, we still see pockets of tremendous spending growth, especially in tourist destinations in the gateway cities. But, there was a huge tailwind post-COVID,
Right.
Where you didn't really have any hotel development. And now, I think it's coming more closer to equilibrium. So you have to be a little bit cautious, especially for secondary and tertiary markets and hospitality. But again, like we're asset agnostic. So we try to underwrite and structure a deal to make sense of it, and have sort of an overall view in terms of asset allocation to be able to have a well-rounded portfolio across asset types.
That's excellent. So we mentioned Fund 5, BridgeInvest Credit Fund 5. It's an open-ended vehicle. Why did you decide to structure it as an open-ended vehicle? How does this position LPs for flexibility versus a closed-ended fund?
Yeah. So Fund 5 was many years in the making. It's kind of a misnomer because it is the first open-ended fund that we're launching after a series of closed-end funds. And it really came from having conversations with our LPs who have been very loyal to us over the last 10 years. We have over a 90% reinvestment rate. And what they told us is they wanted to be able to compound their wealth and really benefit from the yield enhancement that we offer, but not having such a short duration where, within 2 years they're invested and we're already distributing capital back. So by having an open-ended fund, it gives them the control, the flexibility to kind of control their liquidity. We structured it with a 2-year soft lock, which matches the underlying duration of the portfolio. These loans are typically 2 to 3 years. So you will have natural liquidity in the form of like the self-amortizing nature of these loans. We expect something like 10 to 20% of our loan book will be amortizing every quarter. And it also allows us to kind of create a very diversified portfolio of roughly 40 to 50 credits that have a mix of some development risk, some traditional bridge risk and value add.
And what types of investors are you seeing gravitate more to these types of strategies?
Yeah, so we've been very lucky to have a very diverse base of investors of over 350 LPs. So mainly those were RAs, single family offices, multifamily offices, bank platforms. We're now starting to see institutions, endowments, pensions, especially with the open-ended nature of the fund that allows them to kind of match their liabilities with a longer term investment horizon, has been incredibly accretive. We have a joint venture right now with a $20 billion asset manager that invests alongside our fund and is able to further act as a diversifier for our portfolio. We also have about 60% of our investor base is non-US. So we have certain tax optimization strategies through the REIT, both for US and non-US investors as well.
That's excellent. Yeah, one of the surprising outcomes of the sort of evolution of the product structure like Evergreen has been the adoption of, by sort of the more institutional players too.
Yeah.
Giving sort of all the benefits that you mentioned. Looking ahead, what's the long-term vision for the firm as a platform?
Sure. So, the partnership is constantly kind of debating how do we grow and expand our platform. And the conclusion that we reached in these discussions is that we want to double and triple down on what we know how to do really well, which is senior secured lending. We decided not to sort of style drift into equity or mezzanine or preferred equity financing. As I mentioned, it's a very large and diversified and pretty fragmented market, over $6 trillion in outstandings. And so there's many different spots that we can play in. I think we worked really hard to develop this vertically integrated platform that can kind of capture these inefficiencies along the way. So the idea would be today we're originating about $1 billion of deal flow a year. We think that in the next 3 to 5 years, we can sort of systematically expand that and have a portfolio that on sort of a steady state has roughly $3 to $4 billion. Our goal is not to be a $10 or $20 billion asset manager because we want to maintain the quality of the portfolio, focus on sort of that boutique niche aspects that drive return. And frankly, we'll continue to invest our own capital alongside our investors and be fully aligned with our LPs along the way.
Well, Ian, this has been fantastic. We really appreciate you coming in and spending the time with us. And thank you all for joining us today. Take care.
Thanks so much.